To the Michigan short-term rentals podcast. We're here today with Strategic Navigators with Josh Sherrard. He's the CEO of Strategic Navigators. They got our attention. One of his associates emailed me and said he wants to show me how to save 40 to 60% off my federal and state taxes. So you want to get a business owner's attention, throw out numbers like that. And so this is kind of our first time meeting Josh. I'm super excited to hear from him and get some insights in how they go about helping real estate professionals and business owners save a bunch of money and keep it in their pocket. So Josh, nice to meet you. Thanks for coming on today.
Thanks for having me.
Absolutely. Hey, would you want to take a quick second and just kind of walk us through your background? Sounds like you've been part of corporate, business owner, and now Strategic Navigators. So if you could just give us a quick rundown of your history, and then we'll kind of jump into some maybe tax saving strategies.
Yeah, well, happy to. I actually was a pastor for a decade and led about 3 different congregations, and my last one was a large congregation, and just kind of felt like I did what I went to do. And my wife and I wanted to return here to the Midwest. That was in Arizona. And so I surveyed some of the wealthy business owners in my congregation. I said, what's your biggest pain point? And every single one of them said taxes, right? You're making $1, you're giving up 40 cents in some case 50 cents to the government in one way, shape, form or the other. And so I went on a journey and started meeting some wealthy families through some contacts that I had, ended up in the offices of some families that you would recognize, and learning that they're all doing some of the same things. And I asked the question, why can't we bring this to everyday business people? And the response was, well, they don't have teams of tax attorneys and they can't stay compliant. And so I decided to build Strategic Navigators with that in mind. So we started off by just working with tax attorneys, and we have several tax attorneys on our team, and we come in and we restructure and we do these strategies. But very quickly I learned we needed the accounting side as well. And so we brought in and began to build an accounting and bookkeeping division as well. And then shortly after that, we decided to launch Private Wealth, which was a financial planning arm, because we just found that it was nice to come into one place and have all things taken care of. So you've got your financial advisor, your accountant, and your lawyer. People normally have those 3 people, but we came along, we said, let's pull them all under one roof. And so yeah, my background, again, weird because it's in ministry, but launched Strategic Navigators about almost 15 years ago now. And it has just been a blessed business ever since. We're nationwide, and we've enjoyed the process of helping people.
That's awesome. And so who would you say, like some of those people that you were connecting with and hearing about their problems, I mean, what's kind of your typical client persona, if you will? I mean, is it a business owner, somebody that owns real estate, or is it maybe a high up exec, or a combination of both? But what would you say is kind of that main persona of who you're serving?
Yeah, our focus client is the business owner, because as business owners and entrepreneurs, we have the greatest flexibility when it comes to the tax code. America is a capitalist country, and as a result, our tax code reflects that if you understand how to use it. And so that's our primary focus, but we also build tax shelters. So sometimes I have wealthy W-2 individuals. Maybe they're working and getting a couple million through a W-2. They're giving up almost half of that in taxes, but we come around and say, hey, look, you took it on the chin already. Let me show you how to build a tax shelter so you never have to pay tax on that money again. So we work with a lot of folks in the real estate world, whether it be, those that own apartment complexes or big corporate real estate, or I have one client, I think he has 100 different homes that he owns and just gets that revenue coming off of those homes. So, short-term rentals, all of it comes underneath our umbrella.
So for us, if we were going to get onboarded, like what would that process look like? So first, take us through the steps that we would go through.
Yeah, so we do have a minimum requirement. It's someone making $250,000 as net profit to themselves. That can be through the combination of a W-2 and a K-1, but that's kind of our threshold. But then after that, we simply do a quick presentation, show them a little bit about what we're about and how we would do this. And then we ask for 2 years of taxes, business and personal, and we ask for an online questionnaire. And once we have those documents, our team of tax attorneys and accountants will build a side-by-side comparison of what we think we can do for that client. So that's generally how we get started.
So before we go into that a little bit deeper in that process, so if you were to find 40 to 60% of savings, can we look back and resubmit from previous years, or is that just moving forward?
You know, Jordan, one of the comments I hear more often than not is, Josh, I wish I met you 10 years ago. And I wish I could go back, but unfortunately, I don't look good in orange or stripes. So we're not going to go back into a previous year, but we can make a significant impact on this year, even for 2025 for many people as we're getting started. I do onboard people as late as December 31st. And so there are ways to save money if you know what you're doing and you're able to structure and move cash around. That's one of the key components. Some people come to me, they've spent everything they had and they owe a bunch of taxes, and it's not, I can't help you. We have to get in front of it.
Okay.
And then, yeah, so some of the low hanging fruit, let's say, what are some of the low hanging fruit, some of the things that you see that, you know, you can suggest for your clients? And then maybe we can go into a little bit more of the in-depth strategies that you might be seeing. And I did have one particular question. I'm sure you see a lot of it with what you do. But like, we see a lot of people that are under the 1031 deadline, right? To prevent the depreciation recapture. Like, what happens? Do you have any strategies for, hey, if someone misses that, right? What can they do? Obviously, they still have the cash, but they won't have it for long if, you know, they go into the next year and they actually don't get into something else. So if somebody misses it, do you have any strategies that can help with that?
Again, I have a strategy that helps you ahead of all of that. And so by correctly structuring, in our case, we have a uniquely structured Wyoming C Corp strategy where we have the ownership of all these assets living inside a Wyoming C Corporation. Now, the current tax rate on a Wyoming C Corp is 21%, but we are hearing out of Washington that they want to bring that down to 15%. If that's the case, we're way ahead of capital gains. And usually we're ahead of capital gains anyway, because there's usually a state capital gains and a federal. And so worst case scenario, we can get the tax bill down to 21%. But if in fact that real estate is held inside this Wyoming asset holding company, then you have several factors that are going for you. One, you've got the ability to do the 1031 inside of that Wyoming C Corporation, but we also create this on a staggered fiscal year. So even if you didn't do it in that window, we stretch that staggered fiscal year so it ends on September 30th, and it starts on October 1. So what that does is it stretches us out relative to both expenses and to purchases. And so we can work within that 1031 framework. If somebody misses it, there are things we can do. Worst case scenario, we can get it down to 21% and then write a bunch of stuff off against it. And we show you how to do that.
Awesome. So when you're looking at somebody and saying, hey, we can save you 40 to 60%, what is the lowest hanging fruit, the things that they're missing out that they should be doing?
You know, it's funny when you search social media, and I personally, I see it all the time. I'm a tax strategist, so I see all these strategies getting coughed up by, you know, these online personalities. The issue is they don't know how to do these things correctly. And what ends up happening is they get zinged by the IRS, and then there's penalties and fees. So one example of low-hanging fruit is the Augusta rule. Most people have heard of the Augusta rule. It's IRS Code Section 280A, and it basically says that you can rent your home up to 14 days of the year and pay no income tax on that revenue. Now, people think, well, great, let's go ahead and do that. Well, they forget that you have to be compliant, and they forget how to even go into their case law and understand the calculation. So let me give you an example. Let's say that we have someone living in West Michigan in a beautiful home on the lakeshore there. We are going to go in and we're going to find fair market value for the overnight rental in that area. Now, during the summertime, you guys know that number is going to get really high. And during the winter, it's not going to be so great. So we're going to try to do these 14 days in the high season. And what we're going to do is we're going to have you work from home. And most people that are entrepreneurs are doing that anyway. I wake up in the morning and I check my email. And so people do that as well. And so what we're going to do is we're going to show a client how to document that. We're going to structure their business so that they can do it legally. And now all of a sudden, let's say that it's a 4,000 square foot home. In that area, let's just say, it's $2 a square foot. I'm being very conservative. So you basically get $8,000 every time you do this. That's $112,000 that we can move tax-free as a deduction from their entity into their pocket tax-free at $112,000. And that's just one residence. You've got vacation opportunities. You've got second homes. That's very low-hanging fruit. But again, you got to do it correctly.
Is the STR loophole? I mean, I think if you want to talk about social media, and I think that's one of the ones that is talked about most on social media, at least in our world, right? We deal a lot with vacation rentals. Is that something that you guys are utilizing or recommending? Obviously, we're not 100% bonus depreciation anymore, so maybe the actual recommendation for it isn't what it was 2-3 years ago. But it sounds like there's a good chance that might be coming back this year. So would that be part of your strategy if 100% bonus depreciation was to come back?
I like this strategy if you're going to buy and hold, right? But if you're like most real estate entrepreneurs, there's a sale transaction down the road. So if you use up the bonus depreciation now, you're affecting your basis, you're affecting everything else that's going on with it. So you have to think about that. Coca-Cola is actually the largest user of cost segregation, which this is actually based on. And the reason that they are the largest user, because they don't go anywhere, right? They're taking the deduction, they're keeping that building, and they're using it and maximizing. Don't forget, it's a one-time hit. And so there are ways, again, to adjust. I will recommend that strategy if I understand what somebody's long-term goals are. But typically, we want to use strategies that you can use over and over again so that you can maximize the tax savings.
And it sounded like the Augusta rule, that's something every year you can just kind of go back to and use for, up to that max that you were talking about.
Yeah, and it works all over the world. I'm from Hawaii, and I took my wife's family on a big vacation, and we all went to Hawaii, and we rented a beautiful home on the beach. And it was 5,000 square feet, and in Hawaii, you can get as much as $9 a square foot. But I was out there, and during the time I was there, I decided to write my book. And so I sat down at the desk, my kids were playing in the pool, I write my book. So 5 days while I'm there, I took $5 a square foot times 25,000 square feet, $25,000 checks. I took 5 of them from my business into my pocket for going on vacation to Hawaii. So needless to say, the tax savings paid for the vacation. Now, again, you got to do it the correct way. But, I just recently got audited by the state of Illinois. And nobody ever liked it. They're worse than the IRS. Nobody ever likes to get audited. But I came out of that absolutely scot-free, no change. All right. So they looked under the hood. They saw what we were doing. And we even pointed out what we were doing, and they said, you're following the law. So of 7,000 clients, we have been audited. We come back no change all of the time relative to our strategies if done correctly.
That's awesome. And I do think, obviously, that's always, some people's biggest concern, right? Getting audited. But that's why having somebody, a professional like yourself, making sure they're doing it the right way, documenting things properly. When you say doing it the right way with that strategy, what are some things that you're seeing done inappropriately? I can say on the short-term rental loophole, right? Obviously, you got to log your hours. People log the wrong hours. They're not logging, they're kind of bulk like, oh yeah, we just spent, 48 hours from Friday to Sunday doing this at the short-term rental. And it's like, all those aren't going to count. What aren't people doing right, or what should they be thinking about on that rule?
So the history of the rule starts in 1954, President Eisenhower golfing at Augusta. And the people around the golf course who own the homes there, they said, Ike, we want to rent our houses out. We don't want to pay any tax on what these golfers are going to pay us. It's going to be a lot of money. And you can almost see the deal going down on the green there. But essentially, this code is intentionally left very broad. It basically says that if you use this place and you rent it less than 14 days, you can basically receive the income tax free. What are most people doing incorrectly? They are finding incorrect fair market values. So one of the things they do is they'll look at maybe the Holiday Inn down the street and say, how much is that conference room for an overnight? Well, guess what? A conference room is not a dwelling unit, so that would fail under audit. You have to use fair market value for the day that you're renting. Some people don't do that. They just assume that it's going to be a certain fair market value. it also needs to be set up in your corporation to be able to do this. This is not something that you can just automatically do. A sole proprietor cannot do this. Just a partnership can't just do this. An S corp can't just do this. You need to be structured correctly legally to be able to do this. And once you get all that done, and again, we're basing all of this on case law, right? Because you've got, decades of case law to show you what has failed when it's been audited and what has been done correctly. We have documentation that we provide to our clients on what records to keep, how much time is necessary to be there in order to be able to argue this in court. And our attorneys are coming at this from a perspective of what would I need in order to defend this? And that's how we're approaching it.
And you said it was a C Corp was the one that would allow that?
No, you can do them from properly structured S corporations and properly structured partnerships, but we prefer the C Corp structure. We do have a unique structure to it that we utilize that, again, causes this to be an arm's length transaction. It allows it to be something that is a very low risk of audit. Whatever we do, we're actually reducing the risk of audit for our clients because we're lowering their overall AGI.
So generally speaking, we've done with our real estate investing basically joint ventures, essentially, where we have a couple business partners and we own an LLC and we purchase our shares with the LLC we own. So under that structure, would we be able to take advantage of the Wyoming C Corp where our entity is out of the Wyoming and then we purchase our shares or equity into the new business through that? What would that look like?
Yes, you can do that. So the way we would do that is we would keep that LLC wherever you are. So maybe a Michigan LLC, and now we would quitclaim deed that into the Wyoming C Corporation. The Wyoming C Corporation, by the way, Wyoming's an anonymous state. Nobody knows who owns anything there. But essentially, it now is the pass-through for whatever happens in that LLC. And so you're not even filing a Michigan state tax return for that LLC because it comes under Wyoming. And so, yes, you can do this. In this scenario, we would push the Wyoming C Corp, do the dwelling unit or the Eisenhower rule, Augusta rule out of that Wyoming C Corp, and that would be the benefit. I do want to tell you something. I'm building a house right now, and I'm about to quitclaim deed it. I'm in Illinois. I'm going to quitclaim deed that into my Wyoming C Corp. And the beauty of this is I get to write off anything related to the maintenance and development of that property. So I've got landscaping, I've got designers, I've got furnishings, I've got second driveway, whatever it might be, I'm able to write those things off. Even debt instruments, you can write off some of that stuff. So the Wyoming C Corp as an asset holding company becomes incredibly valuable, even in regards to your main residence.
Even the primary residence, you can write all that stuff off.
Yeah.
Wow.
And you could utilize that anywhere in the country.
Anywhere in the world.
Wow. That sounds like a quick win for being able to reduce getting close to that 40 to 60%.
Yeah, some of the other quick things, hire your kids. People hear about that all the time. They do it incorrectly. We do that out of a management company so that you're able to legitimately deduct that expense and then pick it up tax-free. Another one is a medical reimbursement plan. We design a medical reimbursement plan that is unlimited. I've got a young son with Down syndrome. We've had a lot of out-of-pocket medical expenses, but our plan is so broad, it covers not only your premiums, your out-of-pocket expenses, but even the unconventional things, things like chiropractor or maybe Eastern medicine or trainers or trips to Walgreens. All of that now is a deduction under our very broad medical reimbursement plan.
Can we go deeper into that? What, like the plan, is this a plan that, other, call it wealthy business owners are part of and they all contribute to the same plan? Or how are you, when you're talking about this type of plan, what exactly is that?
Yeah, it's not something you purchase. It is actually out of a management company that we create, and your children and yourself, you and your wife would be employees of this company. And as employees, written into the documents of the company, it says that they are allowed to have this medical reimbursement plan and they're going to cover your expenses. So let's say you worked for, Ford or GM and they decided we're going to do this. They could do it under publication 15B. We see it all laid out in cafeteria plans, but we're just building a management company that allows you to do it for your family. It includes college as well. So if you've got a kid that's going to college, not only can we pay them $14,000 and deduct that, but we can also then give the institution that they're going to $5,250. So now you're close to 20 grand a year that you're writing off if you're paying for college. I mean, so, there's lots of great advantages. Everybody's different, but that's why we do the complementary analysis.
Would that work for like a private school for the K through 12 as well, similarly?
The 14,000 does. You can use that money to do anything for the child. It has to benefit the child. That works. In many states, you're going to get a write-off anyway for private education. So we want to make sure that we're maximizing that and not using something that we've already been able to take advantage of on the personal tax return.
Awesome. It sounded like you were going to give a couple more tips too before I cut you off. Sorry about that.
No, that's all right. I was going to go into college. We can also write off long-term care. We can write off disability. People don't know this, but we can write off child care. That's a really big one, to write that off out of the management company. So I call them singles and doubles. Another big strategy that we use is, I referenced it earlier, staggered fiscal year planning. So what we would do is we would set up an S corporation from, January to December, traditional fiscal year. And then we would set up another company that would start on October 1 and end on September 30th. So in that Q4, when you know how well you've done and people are scrambling, right? Do I buy a new truck? Do I buy more computers? What do I do to write off for my business? Instead of doing that, we simply move money from the S corp to the new management company, and it creates a deduction in that fiscal year. And then what ends up happening is the money sits there for another 9 months available to be spent on behalf of the business or on all of these things that I just mentioned. So we're basically stretching out the time that you can spend on spending this. And so again, it takes cash, but this is a very valuable strategy for a lot of our business owners.
Our 529 plan, I mean, I know those are really, kind of low-hanging fruit for a lot of people. I mean, is that part of your strategy too? I was going to say, I've heard of, instead of putting it in your kid's name, you put it under your name, and then, you can still use it for your own education and that kind of stuff. But doesn't sound like it's really part of your strategy.
No, and I actually tell people to get out of any plan that the government has created for your benefit, because they're not looking out for you. So I actually advise against a 529. I would rather you use the hire your kid strategy and the college benefit. Again, $20,000 a year deduction. If you're a business owner, that's the way to go, instead of trying to save up a big lump sum of money. Now, I can show you how to, again, create tax shelters for your kids that would end up being valuable if you want to use that 14 grand toward a wedding fund or a new house fund for your kid one day. I can radically do that for them. I would say that the other thing that the government puts out is the 401k or the SEP IRA. You might go into a CPA's office and they'll say, hey, we have a great strategy for you. I was actually just on the phone with a group out of Nashville that works with music stars. And I said to them, the CPAs, I said, hey, what are you guys doing for strategy? And their response was, well, we do SEP IRAs and we maximize those deductions that way. And I just kind of chuckled inside, because that's not tax planning. That is simply kicking the can down the road. All you're doing is saying, I believe taxes are going to be less for me in the future than they are now. I don't trust anybody in Washington. I don't think taxes are going to be less in the future. I think if I can get a savings today, I better do that, and then I better put it into a tax-free world. And so that's what I teach my clients to do. I even have people, I use this word, it's kind of strong, I have them evacuate any money that they have in a tax-deferred situation, because it's just dangerous. And I don't like that uncertainty when it comes to your wealth.
Well, let's talk about some good evacuation strategies, I guess, on that. I mean, I think me and Jordan are usually on different sides of the coin on some of that. And I think he would align a lot with you. And I guess for a lot of us, it's just that easy button, right? Of like, oh, instant, hey, I'm moving capital from here to over here. I don't have to pay. It was easy to do, but now you got a bunch tied up in there. And like you said, do you think taxes are going to be more or less in the future? And likely going to be more. So in terms of evacuation, let's talk evacuation a little bit.
Yeah, it really depends on the age, right? So when I say somebody comes to me and says, I got $500,000 in my 401k or my SEP IRA or whatever it is, and they're in their early 50s. If they come to me in that situation, I'm gonna look at their overall plan and I'm gonna say, we need to be careful not to face those 10% penalties and the taxes as we pull it out. But if I'm lowering their income, right? If I'm lowering their AGI with all my other strategies, then maybe we can slowly start to siphon off a little bit at a time to get the money out. We may need to do that over the next 10 years, but we need to do the math to make sure that it's more beneficial to them that way. A lot of times what people would do is they'll look at that 401k and they'll see the $500,000 and they'll think, I have $500,000. And I remind them, no, you don't. You really have about $350,000 if you're lucky. And that's assuming taxes stay the same. Now, I will say this, one of the big ideas that come out of the financial planners' mouths is, hey, when you retire, you're not going to have a mortgage, you're not going to have a lot of expenses, and you don't need as much money, so you're going to be in a lower tax bracket. I say that's a bunch of hogwash. None of the entrepreneurs I know want to reduce their lifestyle when they retire. If anything, they want to do more, they want to travel more. And so why in the world would I get into a situation where I needed to keep my income low just in order to get the money out? So no, I don't think there's any good argument for keeping the money long term. Evacuate it. Again, use our strategies, bring your AGI down, and then we can slowly piggyback on that little amounts. If they're over 59 and a half, we look at stronger movement because we're not dealing with the 10% penalty, but we are still dealing with tax. So we'll address that and again build a global plan and strategize that for them.
So even if let's say 35, 40-ish, you'd still use your strategy to lower the your income and then start evacuating it little bit by little bit into a different area. Where are you taking it out as income, or are you just taking it out and moving it in? You're probably moving it into something different typically.
No. Yeah, we are moving it into something different. I have a unique designed a vehicle that I call a rich man Roth. So you're all familiar with Roths, right? Where you can put money in after tax and then you never paid money on that growth ever again. Well, what the wealthy have done in our country for decades is they've used the IRS code to basically be able to rip the top off of that and say, I can put money into this vehicle without paying tax on the gain ever again. And I can get access to that even before 59. I'm not required, 72 and a half. I'm not required to take money out, minimum required distributions. And it becomes much more aggressive planning for their goals.
I would say too, right now, I mean, there's a lot of volatility or a lot of unknown in the tax planning space, right? Is there certain predictions, I guess, in terms of like, hey, 100% bonus depreciation, we feel confident that this is coming back? I just seen something the other day. I mean, obviously you're working with clients 250,000 and above, but also, hey, you're not going to be paying federal income tax on 100 if you make under 150, right? Whether that's true or not, or whether that'll happen, we'll see. But are there certain things that you think the new administration is probably going to, either they did it in their first term and you feel confident it's coming back? Any big tax things that you see coming?
Yeah, the biggest one really, and the most realistic one, if you study economics, the biggest one that helped us was when Trump brought the corporate tax rate down to 21%. What happened was all of a sudden you had international or US-based companies that were now bringing their production back inside of the US because of that, right? It was cheaper, and people like made in the USA, and that's part of the campaign promise that Trump gave. So of all the things that are being proposed, I think the most realistic one is to reduce it from 21% to 15%. It is going to infuse the economy in a radical way, much like it did previously. Now, I also think it's funny that you mentioned the 150,000 or less. It's very campaign-like, and actually, when you look at the math, that group of people doesn't pay a lot of the overall nut. So by giving that to them, you've won the populace. And I really think that if Congress can stay aligned and Trump is in office, I think that could be a reality. Unfortunately, like any law, like anything that we do, when the pendulum swings the other way, we don't know what's going to be undone. And so you've got to be careful. The bonus depreciation is very much something that helped a certain segment of people. And I can see the energy being shifted to something that would help more people. And so I'm not confident that that's coming back, but hey, I'd love it if it did. That's a great strategy. Another one that I've used before is conservation easements. People have done this for years, and it's where you put $1 into a conservation easement, you get a $4.95 write-off. So I have clients who would drop $100,000, get a $500,000 write-off. That's really valuable if you're up in that, $1 million to $3 million range of income. That has gone away. It's a listed transaction. I have heard from my contacts in Washington that is coming back, potentially even as quickly as January of next year. So, you never know. It's Washington, right?
Yeah. If those changes were to take place, is there like a timeline that you would anticipate seeing that by, in 2025?
I would be surprised if we didn't see proposals in 2025. But if you know anything about Congress, they don't move quickly. And so I wouldn't imagine anything would be impacted or affecting us until 2026. And so our mantra has always been, even when we hear these things in the law and in the media or whatever it might be, we have lawyers that are reviewing the law constantly, and we don't plan on speculation until it actually has become hard and fast law. And so, I love some of the ideas, but we've also been around long enough to know there's been a lot of promises, and I want to make sure that it's in black and white before I start doing something.
Absolutely. Well, Josh, thanks for coming on and sharing your wisdom with us. If you are someone that makes over 250, you can tell Josh is someone that could definitely have a big impact on your tax liabilities. So, and it sounded like you do a free intro call, or tell us a little bit about that.
Yeah, we have a complimentary introduction where we'll outline some of the strategies that may apply to whoever it might be. We've got agents spread across the country who can do that. I can even personally jump in depending on the client. But essentially, we will show you what we can do. Then we will ask for those documents in order for us to do that complimentary analysis. We also sign confidentiality agreements and can do that for those that are concerned about that. I will note this for real estate and for realtors. A lot of times they come to me and they say, I'm getting a W-2 from my broker, or I'm being paid 1099 to me personally. And they may come to me with some of those concerns. I have restructured contracts for many in the real estate world because it benefits the broker. I've even worked at the number of brokers. So we can come into an office, we can come into a group of real estate individuals and radically help them. That account that they keep for taxes, that 1/3 that you're told to kind of stock away, what would you do if you could have access to that? So that's kind of where we come in and we can help restructure and guide them. So
awesome. And then it sounds like you have a book. So maybe if you're not at the 250 yet, pick up the book. What's the name of the book?
It's simply called Navigate. Stratnavinc.com is our website address. There's a resource tab. I actually have a number of books on there that would talk about tax strategy and just give people a little bit of a feel. I didn't come up with this stuff. There's a lot of people talking about it at high levels. The family office level uses everything that we're talking about in spades. And so we're just, again, compliance. That's the name of the game.
I guess while we're on books, outside of your book, what's your most recommended book to somebody?
Well, if you want to understand the banking and the economics, you were talking about 401ks and all that kind of thing, Pirates of Manhattan is a good book. It's an older book. That's one that you could read. I've got another one called Tax-Free Wealth. Many people know Mr. Kiyosaki. This was written by his CPA, and it addresses some of these. Those are probably two of the top ones that I send out. I also send out a book called The Power of Zero, and it is talking about the dynamic of not having to pay tax on your investments as they grow. So,
Awesome. And if anybody wanted to connect with you, are you on LinkedIn?
Yep.
Just go to the website.
You can go to the website. There's links on there that you can take straight to my LinkedIn. Otherwise, look me up on LinkedIn. I sit on the Forbes Finance Council. I've got some articles there. glad to interact with various people if they wanted to ask questions of me. I'm glad to answer those. I also have on my executive team tax attorneys that are JD LLMs. I've got forensic CPAs. So there's really no question or situation that we haven't either touched on or addressed that we've come across, at least, that we're unfamiliar with or can't do the research on.
Awesome. Well, Josh, thanks again for coming on, and until next time.
All right. Thanks, guys.
Take care.